Welcome to Finance for Nature podcast. Our vision is to help more nature projects get funded so we can make this planet a safer, more peaceful place for future generations. In each episode, we'll invite experts from extensive experience in finance to share their knowledge and insights. Our first guest, Marta, we were very lucky to have her. Thank you so much for coming and spending time with us. She will be walking us through how capital raising works and how you can apply these strategies to your own nature projects. Marta brings over 30 years of experience in banking, securities, and funds. She currently works in a global corporate finance firm and also runs her own business focused on sustainable energy projects. All right, let's dive in.
Thank you so much for joining us, Marta.
Thank you for having me.
We're going to be exploring how raising capital works for nature projects today, aren't we?
Yes.
So do you want to start with a little bit of background about you? How long you've been doing this? What kind of experience have you got?
Sure. And thank you so much again for having me. This is a great opportunity. I'm very excited to be here today. My background is really finance at the beginning. So 30 years in banking. Spent 25 years at Citigroup in various locations around the world, predominantly in the securities and fund services space. So nothing to do with nature projects. You're putting my carbon footprint on the tube and on planes more than anything. And when I left, that's when my journey has started in the sustainable as well as the nature project space, which is my passion. I thought that if we're making money, at least do something good.
Yeah.
I think you reach that age and stage when you think that's the right thing to do.
Mm-hmm.
So that's when I started getting involved in corporate finance and capital raising, and focusing on many different areas. But I think sustainability, healthcare, and again the technologies around saving the earth and our carbon footprint and how we can utilize AI and blockchain technology to help us. So I think that's been the focus after that. I'm very privileged to be with US Capital Global, which is a amazing firm with a global footprint to help mid-sized companies scale up, and realizing that there's a gap there and that these companies need the help to get to the next stage.
Fantastic. I think to start with, just understanding, really taking it right back to basics, but why do companies actually raise capital in the first place?
It's a good question. There's many different reasons. And sometimes companies don't exactly know why they're doing it. They just feel, I need some more money. So that's the wrong way of going about it. So this success factor number one is know that you do need it, how much do you need, and what you need it for, at what stage. It's very, very important. I've seen people asking for too much money or too little money. You can make that mistake. It's not that obvious. People raise money to start up, to grow, for strategic reasons, for bridging a gap. So there could be a combination of all of those as well. But I've seen, again, people making mistakes by choosing the wrong investor. So it does matter where the money comes from. And it does matter how much and how you use it and how responsible you are from that moment when you even start the process. In the industry, there are different labels which people use: pre-seed, seed, series A, B, and IPO stage, etc. But translated down to normal, I think, language as well. Sometimes I don't, so keen on the labels. First, when you start out, you need to see, do I have the product or service? First of all, number one mistake people make is, do I have a demand for my products and services? Are we solving a problem? Are we finding a solution? Or we just think that everybody wants purple socks with red stars on it, and maybe we find that nobody does. When you start, you need to validate this. You need to develop your products and services and meet the market demand. So that's when your own funds come in. That's what they call the pre-seed and bootstrapping round. That's when your friends and family come, and smaller angel investors who believe in your idea and invest. So that's the early stage when you only need, let's say, between 50 and 500K. It really depends on what you need. Later stages, investors will always appreciate and look for you putting your own and having the skin in the game, as they say, because that absolutely increases confidence. It's one of those things that if I wouldn't put my money in, would I ask for your money? I wouldn't, but many people may. So once you've reached that stage and you've got your product and you're looking now in product market fit, that's when you go for the next round, which will be the seed, which is between, let's say, 500 and 3 million. Depends. That's when bigger angels still come in. That's when the VC angle comes in. It can be family offices. It can be high net worths. It can be strategic investors funds. At that point, you'll be able to go for grants for different incentives, which either governmental level or specific organizations can offer. So that's a good way of scaling from that. And then you reach the next stage when you really need to scale, when you have those orders which you cannot fulfill. There's a lot of business actually fail by not preparing that. What if I get a big order? How will I be able to fill? I've seen businesses fail. Equally, people fail because they think they're going to have, when investors don't really like that. When you go and say that you've got $1 trillion market, which you're going to capture by next week. So you have to have a balance, but that's when you scale up geographically, product or service wise, strategic partnerships. And that's when the more serious investors come in, and at the PE level, serious, more bigger family offices, impact investors, if it's nature projects. And then we go to the Series B when is the next level, when you're talking about international expansion and different level before IPO. So I think that's the broad definition.
Yeah, the different stages. Yeah. And in terms of raising capital at all those different stages, does it look similar in terms of the process you go through? Is it talking to investors and giving them certain documents? Do those documents look the same? Like, how do they compare? Like, if you were starting right at the beginning or trying to scale up, how different, how similar?
It's a very good question, because sometimes we say it as well, that whether we raise 1 million or 15 million, it's almost the same amount of work. Compare a startup which just raising 100K to begin, because you don't need the data room with hundreds of documents in, which obviously when you go to ETA and asking somebody for 50 million, you will have a lot more detail. But in terms of making sure you know what you're doing, you prepare. People who are not prepared will again fail. So prepare all the documents for every eventuality, for every question you may get. Of course, you need to have your collateral, your pitch decks, your teasers, your financial models, your revenue models, your market research and business plan. So there's a huge list of documents I could just give you at either stage. And I always think that it's best to be over prepared even at the beginning. Again, you won't need, let's say, extremely detailed technical drawings for the chemical, the composition of which you're going to need in a lot more detail, but always have everything ready and prepare for all questions which you think you're going to ask. And when you get those questions, make your collateral and package dynamic. Include those questions you were just asked yesterday and you had never thought about before. Because next time it can be so build up that repository, because investors are investing in people. When you walk through a door, if you are knowledgeable, professional, respectful, and collaborate, your chances increase tenfold.
So I'm kind of gathering there that it's a bit of an iterative process where you go and you do as much as you can, and then you start to speak to investors and see what different questions did they ask us that we weren't ready for.
Yes.
And then you go back to the drawing board. How can you do that in a way that is sort of de-risked in some way? Because you don't want to go to a big investor and then show them all your cards. And so how would you do that in a way that's more maybe measured?
Yes, I think it's a great question. A lot of the times people come to me and say, well, we haven't raised. It turned out that they went to the wrong investors, or they went to the right investors too early, not prepared for that. So as they always say, when you're interviewing, don't go for your most desired job as your first instance. But again, test your products and services. They always say as a startup, talk to your friends and family, and then the customers, and then the smaller investors. Gather as much as intelligence as you can. So when you reach that stage, you will go into the right people. I've spoken to founders who were raising, let's say, 5 million, but they were going to investors where their minimum was 50, and they wonder why they. And it's just no point. It's great to talk to them and gather as much intelligence as possible, but just make sure you know. And that's why, for example, working with somebody like a professional in the corporate finance space, like US Capital or similar, can do the make or break, because we will know where to go at what stage. You can avoid, again, wasting a lot of time, because it's hard enough.
Yeah, it is. Yeah,
it's hard enough.
Definitely. So then in terms of those common mistakes, so you mentioned a few there where you might be ill prepared for these things. but working with someone that's an expert obviously makes sense. But
Yep.
what sort of common mistakes do you often see when people come to you or when they don't? How do you see them fail?
Often, I think the people I see, they would have already thought about it and they're ready, or they're scaling up. But let's say in my years, I've seen people who weren't prepared, who thought that when an investor will ask you, so what's your pipeline? Have you got orders? Is anybody interested in your product? They were kind of dismissing that question and saying, yeah, of course we do. Of course we will. We just need the money and then we'll get it. No problem. So that may not fit with all investors.
May not.
May not. And I think part of it is, we're talking about success factors. When I've seen some founders, maybe they thought they knew a bit too much, or more than an investor, or not listening to feedback. And there's a balance, of course, to when you listen to feedback, because you have to build it up and you have to really know what you're doing. But I think it's don't be arrogant. Do listen. Do take a sort of a feedback on board and analyze it when you come back. But I think definitely be ready, be open, and work together, because you ultimately want to have an investor on board where you can work together. Now, some people want investors who just give me the money and we know what we're doing. Others specifically want somebody who will be helping them along on a daily basis to succeed. But again, you have to know which one you're going for and work together with them.
Yeah.
So, when you mentioned about investors have different wants, they want different size of investment and all these information. How do you as capital interact with investors so that you have proper information about the investors, and therefore you might be able to connect to the right people?
Yes, I think this is the key. Exactly, as you don't waste time, and you're talking to the right people. And I think once somebody told me that sometimes you admire the people's ability to waste their own time. So I think this is a really good one. So we don't want to do that. I think one is knowing at US Capital, we have access to 500,000 investors around the world. Each of the senior bankers have a small group of investors. We know what they want. We know them personally, which is very important in this space. Once we exhausted that avenue, then of course we widen our outreach, and we always have a targeted outreach, because sometimes we may not know every single investor. I was working with a cancer vaccine company not too long ago. I may not know every single cancer vaccine specialist, but then we will know within the company and we identify the right people. So I think go and identify the people who will be interested in that sector. A lot of investors are sector agnostic, but some specifically family office, they want medtech or healthcare because that's their passion and that's their expertise. So don't take some AI or fintech. They're not going to be, they may listen to you, but you wasted your time. So go to the right people who invest at the right stages. Sometimes a misperception as well that the larger VCs, for example, they only care about this level or that level. Sometimes that's quite flexible, but again, know where it's flexible and know where it's not. Take them with the right deals which are of interest. Interesting, when I talk to investors, often their biggest sort of issue or complaint, if you like, is we need more quality businesses. You think they're flooded. They are. Still, the quality may not be there. Now, again, it's very subjective. I've seen very interesting businesses getting money, whereas what I thought was an amazing business with the right sort of mission and cause and didn't, or took longer. Again, you have to see. I've seen people make this investment decision based on the color of the presentation. So you have to be conscious of all facts and really just go with the right people and the right level of detail. And really your pitch and messaging has to be really, really clear. And ultimately, they're investing in people. You can have the best idea, the most beautiful business plan, and the wonderful numbers. If you, as a founder and your team, not able to execute, you won't. I've seen this happen as well. Just because you're an amazing scientist or sustainability specialist doesn't mean that you can run a company, or you can raise money, or you can succeed.
So just on that, because that's a really interesting difference that we've seen as well, where people in the nature space and in the financial space or the business space sometimes don't speak the same language.
Nope.
You suggest somebody that maybe is in the nature space, maybe they're a scientist, like engineering background, something like that, and trying to move into the business world, maybe commercializing an idea and maybe raising capital to do so. How would you suggest they go about doing that?
Very good question again, because I've recently been working with one of those founders who's an amazing scientist, very knowledgeable and business savvy as well, but not just quite enough to get things done or get things through. So that's when sort of partnering with a professional to get you on the investment journey helps. But then you have to think about, I've got another founder who is an excellent person to execute, to run things, to 100% get the money and get things going. That doesn't mean that he will be the right CEO going forward. And he doesn't want to be, in all fairness, because he's an execution guy. Once he's going, then you include that we're going to hire a CEO, we're going to hire a CFO. And some investors I've seen as well, they stipulated that I love your business, I love this, but can you hire the right person to run it? Because that's two very, very different things. So I think you have to strike that balance and again, listen to feedback. If you're one of those who won't sort of get anybody else in, fine, you can try and you may succeed, but sometimes it's good to everybody has, we're all good at something and not so are the other things. So I think it's just crucial to get that right.
Yeah, definitely. So I'm hearing like partnerships are good for professionals, and then maybe considering where you can bring in other expertise that were maybe from someone that's done this before in the same way. And then maybe that scientist or the engineering expert sits in a CTO role rather than the CEO or the operations or finance, and then bringing those people in. Okay, so let's move to a hypothetical now. So let's say we've come to you and we've said, we've got a nature project that we'd like to work with you on. At what point should we actually be coming to you and saying that, like, we're ready to start raising? Like, is it, if we've got like an idea, is it there? Or like, is it good to start the conversation? Or if we were to be coming with a nature project, what would that look like?
I think as a friend, you can absolutely talk to me about the idea. I love that. But when you're looking for a professional or when you say, okay, we're ready, you would have had the idea, you would have had your market research, you would have had, in fact, depending on where you're raising, even at the very, very beginning, you would have had to have already your product and services ready, developed, MVP, tested. It depends on let's say if you, one of my passionate sort of area and project is green waste to energy, for example. That's a great example because it's a circular economy. So we know, is there market demand? First of all, yes. With green waste to energy conversion, or let's say biochar, you are solving several problems. Have you thought about that you're solving the waste management issues we have? Of course, the air pollution. You're contributing to the net zero initiatives and you're making money on carbon credit sales, on biochar sales. So you have to do the really, really detailed market research. I think a business plan, which could be a pain, and I know we can do it with AI in 2.5 seconds. But as a founder, what I found as well when I set up my own company and I had to do my own business plan is that's when I really thought about everything, because it made me think about everything. And then I had the issue of, okay, 65 pages is too long. Let me try to do 30, but not under. So I think about all the angles, do your research, have your product, test it, and it depends on which stage you're at. And then you start to say, okay, this is how much we need, what for, your pipeline. So for example, we're talking about the green, you have to have your feedstock suppliers, at least 1 or 2 already secured. This is when it doesn't work. That we'll find somebody, I'm sure, because there's so much green. Yes. However, you have to have your technology proven and tested or validated by somebody, because the investors will ask, how do you know that when you put the green waste, something else will come? So obviously you have had to have that done. You have to know what you need money for, exactly how much that machine is going to cost, what's your revenue model look like, what's your offtake agreement on when you produce the biochar. Excellent. What are you going to do with that? Is it for the farmers? Is it for the company? Okay, you produce carbon credits. Wonderful. Where is it going to go? There's huge value. So once you've thought about this whole circular economy and created your business model around it, and you know what you want, that's definitely now. People come to, like yesterday, I had a call with a client, a potential client, who we had a great chat. they're not ready to raise till next June. But that's okay because we already had the chat. They know what they need. And that's a very good early preparation. Some people, of course, come to us when I needed it yesterday. That's very common. Again, don't wait to that state. That's very crucial. Investors want to see that you have a runway. They really don't like you say that, oops, I just realized yesterday I run out of money. Can I have, because they, it forms a character of how you're going to manage when I give you 5 million. Is it going to be? So I think this is very, very crucial that when you're ready and know what you're doing and how much. And then, of course, the professionals like us will guide you through it.
Yes.
So that's not a problem.
So in terms of those timelines then, let's say we're mid-market, we're doing maybe that energy, the
Yep.
waste to energy on, and we're coming to you and we're saying, we've got a runway and we want to raise it this time. How long would that runway need to be? Like, what would it be? 6 months before be a good time, or?
Yes, it's a good question again, because you need, let's say, I would just say just a ballpark figure. Depends on which stage you're at, of course. The mid-sized company stage, let's say 6 months minimum. That's a good one. 6 to 9 months, even better. Recently, after lockdown and with all the political and economical situation right now, it could be even longer. So often people have this perception that they come to a professional like us. Marta goes and meets somebody for lunch, and by the end of it, she will have a check of $10 million because she knows people who will do that. Well, we may know people who will do that. I wish it was that easy, but some people literally think that's how it goes. So you have to manage the perception that no, but it can be, sometimes it can be surprisingly quick. We've had clients where we had 6 term sheets in a very, very quick space of time. And maybe it's not something that you thought you would. So sometimes it's surprising as well. But 6 months minimum, 3 months, that's like a really rush job. I cannot say to people that you will, it depends. They're just raising a bridge loan for something is a different story. Yeah, at least think about it a year in advance or 9 months in advance and start 6 months minimum.
Got you. And then so they're coming to you, or we're coming to you with a hypothetical. We've come to you 6 months before. We've got a good amount of, we've got all the offtake agreements, we've got all the documents in place. And then what's the next step after that? So we've come to you and then we've said that, do we just give you all and you run off have some lunches with people? Or
See you later.
Yeah, exactly.
See you later with the check. So what we do is when we have founders and businesses come to us, we do talk. And we do talk a lot. Mm-hmm. So we certainly don't do give me a quick 20 minutes. What's the numbers? Okay, send me a page. Like, okay, bye. No, it's definitely a working partnership because it's in both our interests. We're both in the same boat. We want to get you the money so you can get going. And we actually want to have a long-term relationship. So I'm not, and even US Capital is not one of those firms that here's the money and buy it.
Yeah.
But keep us posted. We have return clients who come back again for the next raise or for the exit or for the. Yeah. So I think it's very important that you come to us at that point, and we have a lot of conversations. We go through in depth what you need, and I think it's at that point as well. It's very important to be completely transparent. We want people who are genuine, who are we're your partners. So tell us everything. Tell us what we need to know. Let's put together the package, the messaging, what we're doing. It would be horrific and horrible. It's happened before when 4 months down the line, something came out. That can't happen. We don't withhold information. So what we do is we onboard you as a client. We make sure that we have a designated team who will do all the due diligence, the background checks, of course, KYC, AML, all those things. Make sure you're not calling us from prison. But of course, we do meet our clients as well if it's geographically possible. And we onboard you. Then we start working on several phases of our due diligence. Work on the legal background, the compliance, the financial models. And basically we put together all those things which people refer to as all the documents in the data room and all the collateral, which is an extremely time-consuming and very expertise-reliant task. Often people underestimate. They think, I just work together, a quick page deck, 6 pages, what can go wrong? A lot of things. So is the consistency, is the professional, because a good point here is, once you go into an investor, they're human beings, most of them. Therefore, when you walk in, you form an image. The presentation, your readiness, your thoughtful preparation already is a yes or a no. They could decide there and then that this is not going to go well. You could have the most amazing thing, but they already have it in their head. So I think that's why it's very important that you prepare everything at that point, which we would do together. And that's when you go out and targeted outreach, we call it, go to the right investors together. First, we see who's interested, and then, of course, we'll get you on board because we're not the experts. We may screen a lot of investors and talk to them about it before we sort of pull you in. But when they're seriously interested, then, of course, we get people into the data room, we sign the NDAs, and we make sure that the legal documentation is all there. That's when they're in the data room looking, and that's when they would indicate to us that, oh, we would love to talk to the founder, or here is 25 questions, which we want you to come back to us, and then we continue. So again, it's a very agile process at that point, and some investors may be there for a very long time, or they show interest for a very long time, but then they drop last second, and that can be very frustrating for everybody. Unfortunately, I've seen, not with US Capital, but we have a good hold on our clients and the investors. I've seen stories when the day before signing and the week before signing, when you worked on it for 9 months, people drop out because, oh, sorry, we just had something better come around, or we haven't got the budget, or like all sorts of, so that it's tough. So you need resilience. One of the key success factors for companies, the resilience and really work together. You just have to keep on going.
So in terms of that, if we were to put timelines to it, so we come to you 6 months for our runway. Maybe the first month or so is clarifying that data room, building that out, polishing those bits up, and then getting everything sorted. Like we making sure we're not in prison, that kind of thing. Exactly. And then maybe is it like month 2 to 3 we start talking to investors, and then we get those NDA signed, then look at the data room, and then we might start to have some initial meetings.
Yeah, absolutely.
And then well, what would happen from there? So you mentioned like signing, like do they give like what's the next step after that?
Yeah, exactly. So you would get, and we prepare all the documentation again for you, all the legal documentation. But at that point, we would start to get offers, term sheets on the table, conditions often, because again, be careful. You may have 6 term sheets, but they could be all horrific. Basically wanting to take over your company before you blink. So you got to be very, very careful of who you accept and who you don't, but for the right reasons again. Reject people if you must for the right reasons and accept them for, again, that's very, very crucial. And I've seen people make mistakes then. Or sometimes the mistake will only transpire, of course, a year down the line. But just this is when the more serious conversations will take place and negotiations around. Really depends on what you have. So if you're equity, how much are you raising? How much equity you're willing to give up? Sometimes you may think you thought about the 15% mark, but the investor says 45 will be nice. So you have to be, and often, of course, as a startup and scale up, the decisions are different, and how much in demand are you, so to say. So again, this is the psychology of negotiations will come in at that point. Again, it's very useful to have a professional partner with you, because negotiating alone as a founder is very, very dangerous. Again, A, you don't know it all, but B, just it's one of those things that you have to be aware. So, and that point, once you've agreed, we're happy, and the bank, so the money is in your account. A lot of the times it could be you're raising funds, and it comes in stages, committed stages, and linked to milestones, which is absolutely fine, because even if you're raising 50 million, probably you won't need that on day one, realistically, because the first 10 million will go towards the machinery, for example. The second is going to be the global expansion and the carbon credit certification, and the expansion geographically and visiting clients. So it's always going to be a staged approach anyway. So some investors will stick to that. Some may say the whole thing. Depends on when you're used talking about strategic investors as well, which I think is an increasingly exciting space.
What would be that difference then?
They would want to have a lot more control over that. This is when you may get an offer for a buyout. your company as well. And some founders are quite open to that from the beginning. If somebody comes in with an offer, some are absolutely against it. It just depends, but it's more like a hand holding process at that point, and they want to make sure that, their strategy
Really
will
kind of guiding you through that and kind of
Exactly.
pulling you through in some way.
There was definitely more we wanted to ask Marta. She shared so much valuable insight. Hopefully, we'll have her back for a follow-up episode soon. Thank you for tuning in to Finance for Nature. See you in the next episode. Bye!